Your salary is not the most important thing when it comes to buying your first house. I know it seems crazy. Money is definitely important, but there are two really important factors that are even more important when it comes to qualifying for a mortgage. Knowing how these other two things are going to impact how much you can qualify for, or if you can even qualify, might actually open up doors that you might think are closed already. If this is the first time that we are meeting, my name is Nobu Musekiwa, and I help women go from confused and frustrated to excited and ready to apply for a mortgage for their first house. I bought my first house in New York City, which y'all know New York City is a very, very expensive place to buy. How much do you think that I was making? What do you think my salary was when I bought that first house? Drop your guesses in the comments and I will let you know what the answer to that is at the end. Something that will take you out of the game is your credit score. What your salary is impacting is going to be how much of a mortgage you can get. With the FHA and conventional loans, with those two loans that are most common, the reason why a lot of lenders give out these loans is that these loans are backed by the government. So in order for the bank to have this extra protection, they have to have a certain minimum criteria in order to make that happen. And one of those things is credit scores. So whether you're getting an FHA loan or a conventional loan, there is a minimum number, a minimum credit score that you need to even be considered for those loans. So if you have less than that number, then you doesn't matter what your income is. You'd be making 400,000. Like you cannot get this type of loan specifically. For an FHA loan, you only need a 580 credit score to be able to get this type of loan. And for the conventional loan, 620 is the minimum for that generally. So some banks will move that up a little bit because they want extra security. They want less risk in the loans that they're putting out. But generally, if you have a 580 credit score, you can get an FHA loan. Some banks go even lower than that. And if you have a 620 credit score, you can get a conventional mortgage. In addition to having to meet those minimums for your credit score, something that your credit score is also going to impact is your interest rate. Banks are not loaning out money just because they want to be nice humans, right? They're lending out this money to make money. And the way that they make money is through interest. So if you want to buy a house for $100,000, you're going to pay back that $100,000 plus X amount of dollars in interest. And that rate is going to be determined, one, there's by just the average rate that's in the market in general, and then what's going to happen is depending on your credit score, your interest rate is going to be at that average rate or even higher. So right now interest rates are around 7%. So in order to get that 7%, you need to be at a excellent credit score, right? So if you are at 740 and above, you're going to be getting that great rate. And the lower that your credit score is, the higher your interest rate is going to be. So if you're on that lower end, so if you have that 580 credit score, you don't expect to pay the best rate. You're going to have a higher interest rate because you are a riskier gamble for the bank. And so the reason why your interest rate matters is because you're paying back how much you borrowed plus your interest every single month. And so the higher your interest rate, the higher your monthly payment is going to be back to that bank. So your credit score can get you out of the game because one, you need a minimum to even get in the game. And then second, if your interest rate is too high, it's going to impact your monthly payments, which is then going to impact your ability to get this loan because of something which most people don't even talk about, most people don't even pay attention to, which is your debt. Let's talk about your debt. In order for lenders to be able to get that loan backed by the government, they have to follow the guidelines for something called debt to income ratio. So what that means is when we look at how much you make every month compared to how much debt you have, it has to be below a specific number. So that specific number is going to depend slightly depending on what type of loan that you have. But let's just say, just in general, when you're looking at all the different debt that you have, it has to be less than 50% of your income. When we're thinking about debt, we're not talking about the total number of loans you have. The lenders are looking at your monthly payments. So if you have a payment for a Chase credit card, that's $30 a month, and then a payment for your student loan, that's $150 a month, and then a payment for your car loan, that's $500 a month. They're going to add up that car loan payment plus your student loan payment plus your Chase card payment, and they are going to look at, compared to your income, what percentage of your income is going towards that debt, right? Now, when they take that debt you already have plus your potential mortgage payment and put those together, it cannot be more than 50%, sometimes 40%, depending on what type of loan you're getting specifically, right? So now the thing that a lot of people disregard is that when you're racking up all these different debts, so if you have 10 different credit cards, they all have balances on them and they all have monthly payments. You have a car loan that's $1,000 a month, which I think is crazy. And then you also have all your student loans. Maybe you have 4 different loans and your total payment for that is $700 a month. When you add up all of those different payments, that alone could take you out of the game. So even if you make a whole lot of money, if you have a whole bunch of different debts that have all these different monthly payments, that could potentially get you out of the game from being able to get a mortgage loan simply because of all the debts that you have. So you could be making a lot of money, but then if you have a whole bunch of payments, that's it, you can't qualify. Similarly, if you don't make a lot of money, but you don't have a whole bunch of monthly payments, then you could potentially qualify for a mortgage and maybe an even bigger mortgage than someone that makes more than you. And so when you're thinking about, do I make enough money to buy this house? It's not just a matter of like, what is your salary? What does your debt situation look like, right? You can buy a house when you have debt, but if you have debts that have large payments, and that's going to get you out of the game, especially if you have a low income. One way you can get around not making a lot of money or potentially having a lot of debt and increasing what you can qualify for is getting a house where you're going to be getting rental income. So getting a house hack or getting a multifamily, and also reduce your debt payments as much as you can. So you don't need to go through and pay off everything, but whatever small things you can pay to make sure that that payment is no longer on your report, that's helpful. But definitely if you want to buy a house in the next 6 months, don't go and buy a new car and add a huge payment. Don't get a personal loan and add a huge payment. Don't do that, because that is going to severely impact your ability to buy that first house. I mentioned earlier that I bought my first house in New York City. It is a 3-family house. So it's a 3-floor house and each floor is an apartment. I'm in one of those apartments. And when I bought that first house, I was making $48,000 a year. So I was making under $50,000 when I bought that house. Even though my income wasn't as high as you would think you would need to buy a house, especially in New York City, the thing that was really helpful was having a high credit score, which means that interest rate was low, and then not having any huge monthly payments, which means that there is a possibility to qualify for a bigger mortgage. And then on top of that, I use a strategy where I was able to get income from potential tenants, and that helped me to qualify for a mortgage. So if you are interested in seeing how you could make money from where you live, then make sure you go ahead and check out that video.